everyone. Do you hear me well, or should I take a mic? Okay. My name is Ali Nuraldin. I'm a co-founder and core contributor at Opium Network. Opium Network provides an infrastructure for creation, trading, and settlement of decentralized derivatives. Today, I wanted to show you like give you a basic knowledge around the DeFi options and the trading opportunities. I'm gonna separate it into these four topics. First of all, what is an option contract? Second, a little bit about the options market, current state of DeFi options, and we will go to the Pi options trading strategies, and then some Q&A session, because this presentation is not going to be that long, so you can have some time asking things that are not covered here. First, I wanted to start, why am I talking about this topic in general? I was a software engineer for many years, and until some point in time, I was very far from anything related to trading in general. So, of course, I didn't even know about derivatives and options, and considered the whole trading and market as a gambling and scam. As I started working in DeFi, I learned what's financial engineering, and I realized that there is a math behind, and I understood that and completely changed my mind about the matter. So I wanted to probably change some of yours if you have these concerns. And it's a relatively complex topic, but complex and transparent DeFi is much better than complex and intransparent CeFi, as we can see what happened in November. And of course, disclaimer, everything described in this presentation is not a financial advice, so you have to do your own research before jumping into anything. So what's an option contract? Anyone here knows? Okay. So option contract is a contract between two counterparties, which gives its holder a right to buy or sell a specific quantity of asset at the specific price, called the strike price, on or before a specific date. So, for example, we can agree that I'm gonna sell you Ethereum at $1,000, I don't know, in 1 year. And what's the difference? There are two types of option contracts, calls and puts, and each option contract has two counterparties, buyer, also known as holder, and seller, also known as writer. So these two guys are basically signing a contract between each other, could be on paper, handshake, or on smart contract, and holding a call option gives the holder, the buyer, the right to buy an asset in the future for at a specific price, and the seller of the option has the obligation to sell this asset. So basically, if it's not feasible, buyer can not execute its contract. But whenever buyer wants, seller is obligated always execute the contract. And on the puts, it's just the opposite. Basically, holder of the put has the right to sell its asset at the specific price, and buyer of the put and seller of the put is obligated to buy this asset at a specific price. Most of the time when option contracts are settled, holders are paying the writer, so buyers paying to the sellers so-called premium, small amount of money, basically, comparing to this its notional nominal. Okay, so here are the payout charts of different option positions that were on the table. So I'm gonna give you like a quick perspective on how the payouts work. Basically, the buyer of the call option starts to receive money, you can see it here, whenever the asset price goes above the predefined strike price. And the seller is losing money from the same point, starting to lose money. And puts is the opposite. So if the asset price if asset is depreciating in price, in value, then holder of the put option receive the payout, and seller, writer of the put option, is losing its value. So it's very important to notice that trading strategies involved in buying calls and puts, these two, are much easier and less risky because, much less risky than the selling because of the different risk profiles. So take a look at the long call and long put charts. You can see here that the only downside that buyers have is the price they pay for the option. And they have unlimited upsides here and here. And looking at the short call and short put, basically sellers of the call and put options, you can see that their upside, so their maximum gain, is limited to that they're receiving, and their downside is unlimited up to losing the whole collateral. And what's collateral? Whenever the option contracts are settled, writer of the option, seller of the option, is putting a so-called collateral, like a margin, into its position. And depending on the type of the settled contract, it may be either fully or partially collateralized. Normally in CeFi, banks would make sure that there is a collateral. However, in crypto, it may be different. Of course, smart contracts gives you ability to make these processes much more sustainable and easier and automated. So you can put collateral into smart contract and make sure that it's there, comparing to the centralized exchanges, for example, which doesn't even have collateral for the spot trading like FTX. So for better understanding, like wrapping up the theory around the option contracts, for better understanding, you can look at this chart. This chart is what you're always using in your life, is insurance. Basically, it behaves as an insurance. So you are, as a buyer of the insurance, you pay the premium, you pay the insurance company the money for your insurance. And if something happens to you, then the insurance company, seller of the put, they have to pay you out. Like if you are having a health insurance, for example, then you go to the hospital and something happened, then they're paying you out. If not, then you just paid your price for the insurance, and you basically just remain insured and covered. However, for the insurance companies, the only maximum possible gain from this type of contracts, they're receiving the premium for your insurance, what you're paying for it, and they can lose a lot. But of course, it's their business. They can set this premium according to the statistics high enough to be earning money, of course, than losing. So why people use it at all? Mainly for hedging, for example, trading companies, and for speculations, like ordinary traders and hedge funds. But the overall option market is huge. It's actually multiple times, like hundreds and thousand times bigger than the spot markets. So you can see here, I wanted to give you a little perspective on the difference between option volumes in DeFi, CeFi, and traditional finance. For a rough calculations, I took 30 days volumes of top 10 option protocol in DeFi. Deribit's trading volumes for CeFi. Deribit is the biggest centralized exchange for crypto options, and not only options now. And for traditional finance, I took just 3 tickers: Alibaba, Meta, and Tesla stock options. So you can see here that CeFi volumes are 20 times bigger than DeFi, and only 3 tickers, Alibaba, Meta, and Tesla, on stocks option market is 3 times bigger than the CeFi for the crypto in general. So I only wanted to show you that so you can understand the potential growth of DeFi option volumes. Yeah, so now let's go to the current state of DeFi options. I took like commenting your words about Ton. You all know that Ton doesn't have much of DeFi yet. And I took here protocols from EVM chains and Solana, which are quite good in volumes, in terms of volumes, total value locked. So to more easily describe you the current state of DeFi options, I separated the list of top 10 protocols on DeFi Llama into two categories. First one is the settlement protocols and DEXs. Second one, DeFi option vaults. I'll explain what is this. So settlement protocol and DEXs is basically like exchanges, clearing houses. They provide the infrastructure for creation of derivatives, execution of derivatives, trading them, and so on. So these projects like Opium, Lira, Zeta, Opium protocol, UMA. UMA lately they changed their focus to Oracle. Still, they have a lot of infrastructure for derivatives. And the second part is DeFi option vaults. Is some of these projects, they still do the settlement protocols, but what unique value they bring as well on top of that is that they allow you to use their automated strategies to basically put your money into their vaults, into their pools, and they do automated trading of the options, and not only options right now, with your money, and you just earn your interest, taking, of course, some risk for this. Those are Dopex, Friction, Tetanats, Premia, JonesDAO, Katana, and Opium Finance. So the list is not that big, and it's because there were actually many protocols on DeFi Llama, but they have much smaller TVL and volume, so I didn't want them to include here. But yeah, and the current users of all these protocols are not retail users, mainly is just market makers and hedge funds. Yeah, so here we go to the Pi options trading strategies, and considering the combination of two previous things that I told you about, the small volumes and liquidity and small amount of projects gives us a first trading opportunity arbitrage. One of the biggest problems in DeFi options is pricing, because there are not many participants and arbitrageurs. So markets are inefficient and prices are either too high or too low. Yeah, so let me get straight to it. Arbitrage, probably most of you know what is this, and it's almost the same in the world of options. You can have two types of arbitraging with the same asset or with correlated asset. So let's take a look at one example here. For example, on one exchange, you buy call option on Ethereum with strike price 2,000 for 10 base points. And on another exchange, you see that you can go and sell it for exactly the same ticker, exactly the same option for 15 base points. So basically, your profit is 5 base points. This is considered the least risky trading strategy. There is a technical risk involving, I don't know, like hack of the exchanges or smart contracts that you're using for this strategy, or maybe a technical risk on your side of your bot, which will not be able to settle some kind of a deal, like first or second one, and you're gonna have to like deal with that. But still, in terms of from financial perspective, this arbitrage is completely risk-free. And correlated assets is something similar. So it's the same approach, but for different assets which have a correlation with the price to each other, or at least you can like calculate correlation for yourself, for your risk model. For example, you can see that 1inch is highly correlated with the ETH, so both of their prices are going up and down to the same difference, and we can say they are correlated. So let's say 1inch at 83 cents. It's all data from November. 1 inch at 83 cents is equivalent, so implied strike price for 1 inch on Ethereum is 2,000. So it means we can, having this assumption in our heads, in our risk models, we can do this arbitrage. You can buy a call option for 1 inch at, for example, 8 base points and sell exactly the same option as in the first example for 15 base points. Having this assumption, you have a profit of 7 base points. So you can execute this strategy in different places. First one is obvious, use DEXs and IMMs and order books, decentralized ones. And another one is not that obvious, and usually only people working in DeFi derivatives know about it, is auctions. So mostly it's related to these projects. Every DeFi option vault strategy is running an auction where they buy or sell options in order to execute their automated strategy. So these auctions are public. There are different kinds. There is a Gnosis auction, Opium auction. Sometimes trades for these projects are even executed in the chat, like Telegram with market makers. So from that perspective, you can understand how early we are in the market. Yeah, I think that's it for the arbitrage. So here we go to a more complicated but still very interesting trading strategy is called, which is called covered call. This is one of the things what these projects are doing. So mainly every this project has this strategy on their websites. And covered call strategy is implying that you are selling call options with a strike price high enough, but still the option is remaining liquid. So let me just show you example on Deribit how it looks like. So if you are going to be executing this strategy right now, right away, what are we going to choose? So first of all, this left part, a little introduction into the Deribit UI. This looks like most of the option trading platforms. Yeah, so left side here shows us bids and asks for option contracts for different strike prices. Yeah, so calls, puts, bids, asks, and here is different strike prices, different tickers. So covered call strategy is implying that you're selling like still liquid but high strike price call options. Meaning, in our case, the less profitable and less risky, but still executable strategy is selling call options for Ethereum at strike price 1,800, and we can get like 10 base points out of it. So you can choose like smaller strike prices, for example, 1,700. Then you are going to get like 3.5 times more premium, but still, but in this case, your risk is getting bigger because once the asset price, so Ethereum price, goes over the strike price, you're going to start losing your collateral, basically having to pay out, which is not bad. I will explain you in a bit how you can consider that. Yeah, but first let's just see how it's executed. So first thing you have to do here is sell the option call contract for a particular premium. So this is your immediate profit, which is not permanent yet. So it's like impermanent gain. And then as a second step, you have two options. First option is buy back the same option back for a lower price, because there is time correlation. With time, every option becomes cheaper if the underlying price is remaining the same. So there is a Greek called theta. It's more complex. I can tell about it later if you want. But just keep in mind that with time, options are getting cheaper. So basically, you, instead of like waiting until the execution, so for example, here we are looking at next Friday, 17th of February. So instead of waiting for that time to execute your position, you can just wait till it goes down in price, and then just basically hedge yourself, buy back the options you sold before, and make, I don't know, like 5 base point profit out of it. But it's a much smaller profit, because like at the beginning you had 15 base points. Then if you buy back, then you only have 5 left. So there is another way of executing the strategy, is just waiting till the execution, which is more profitable because you keep the whole premium that you received for yourself. And yeah, but it's more risky, of course, because at that point you could be liquidated, or you are going to have to buy back your options if the asset is going like up greatly. 1 second. Yeah, so about execution. Or probably I'll just explain you the chart here first. So here is the strike price, for example, to 2000, what we agreed. And here is the break-even point. So basically the amount of money you paid, or you received for the option. So at some point, execution of it becomes like 1 second. This is an old chart. Yeah. So as I said before, as a seller of the option contract, you have capped or limited maximum possible gain, which is the price that you're receiving. And once your asset is appreciating in price, then you're gonna start losing it. So basically, in terms of ETH here, you are gonna have less ETH in your contract. But since the ETH price is going up, comparing to the US dollar value of your position, you are gonna remain the same. So this is why like this strategy could also be considered as a limit order with additional APR on top of it. So basically, you're putting limit order that you are willing to sell Ethereum at 2000, which is much higher than right now. For example, 25% higher price than right now. You're willing to sell it at this price if it happens. And meanwhile, you are getting this additional premium, additional APR on your assets. So here you can see the example. We received 15 base points, and if the price goes up above the strike price, so you're just receiving your $2,000 for your Ethereum, and that's it. You don't lose anything in terms of USD. Yeah, but if you look at this chart in terms of ETH, you're gonna be losing your collateral here very fast. Yeah, so basically risks in these strategies are as well technical as in everything that's happening on chain, off chain, and so on. And financial risk here is just selling your asset at a strike price, which for some people are not risks but opportunities. And you can calculate like approximate APR on what you could earn from that. Like if we sell it, for example, this one for 10 base points. So we have like 10 base points is what, 0.1%, and compounding interest. Oh my God, 1 second. Yeah, so basically compounding and selling this type of option every week will give you 100% APR. But of course, this is a super risky strategy. You're gonna have to hedge. You're gonna have to like sell some of the part of these risks, and then you will get the smaller APR. And also, it's really important on how much collateral you put inside. But this is a more complex topic. If you want, at the end, I can talk about it. Yeah, so let's get to the next one. Next one is called cash secured put strategy, which is similar to the covered call, but instead of selling call options, you are selling put options. So, and of course, here on this side, it's like in reverse. Basically, the bigger, the smaller strike price, the less liquid are options, and the less profitable if you sell them. But with the increase of the strike price, it's getting more risky and more profitable. Yeah, in terms of execution, in terms of execution of the strategy, it's the same. So you can either buy back your sold options for a cheaper price after some time, or you can wait till the execution to get maximum gain out of it. And in terms of execution, you can consider it as a limit order as well, but not to sell the asset, but to buy the asset. So basically, you agree to purchase Ethereum at 1,000 if it goes below that. So if not, then you're getting the premium on top of your trade. Yeah. So financial risk here is basically buying Ethereum at a low price, which is also opportunity for some. Yeah. So in general, that's it. I will leave some space to for your questions. Maybe some more deeper technical details. I will be here the whole day, I think. So if you want to like sit down and get on some example, also possible. If you have any questions left, you can find me in Telegram and Twitter. Write me. And additionally, I wanted to ask those of you who haven't done it yet, visit the setalexfree.nl website and sign the petition for Tornado Cash developer, who is unreasonably imprisoned for more than 6 months now, and his imprisonment is a threat to all open source development and developers. I would really appreciate that. Thank you. So if you have any questions, shoot.
Maybe I want to stick a question, but what's, according to you, the difference between trading crypto on this basic trading crypto platforms, like say Binance, for example, or KuCoin, and the trading platform you've been talking about, which is kind of like trading with options, right?
I did not get the question. Can you maybe rephrase?
I understand that the platform you were talking about and the tradings you were talking about is not about crypto, it's about options, trading options, right?
Yeah, it's a synthetic contract on top of the asset. So basically, on the spot market, when you buy and sell Ethereum, you just buy and sell physical Ethereums. But here, you basically bets on the price of Ethereum. So you don't need Ethereum itself. You can. That's why the derivative market is huge, because you don't need an underlying asset to trade options for it or derivatives for it. You just need its price. So even if it's traded like in one place in the world, then you can have like the whole world trading contracts and betting on the price of this asset. So yeah, and the trading is completely different from the spot trading, because you need to like think about this stuff like collateral, how much money you put in, you can get liquidated. But it's for me personally, it's much more interesting because there is a lot of math in there, and you can like all these strategies. There is like a lot of strategies that you can just using formula, using science. You can just do arbitrage completely risk-free and pretty profitable, especially in the current state of DeFi, where like there is literally almost no one arbitraging it.
And have you managed to create already your own bot, which is kind of working quite good?
Yeah, well, I'm like yeah, but it's not. With the basic stuff like this stuff, like arbitrage or covered call strategy, is actually pretty easy. All the strategies I told you here, and there is another one which I did not explain here, but I was running it like from July for myself and for these two guys, and it was a pretty interesting strategy. I realized like with this price of the asset, like staying on the same level. I told you that options prices are getting cheaper and cheaper as they're closing to the expiration. So basically what I was doing is I was selling options in the Thursday evening and purchasing them back on Friday afternoon. And if market was not volatile, the price was always lower, so it was like always no-brainer and money maker. And it worked. It worked pretty well in most of the times. But I wasn't hedging it, so I wasn't like mitigating some risks of volatility. That's why I was always like scared and stopped trading it. But you can actually hedge the volatility as well, and you will receive like smaller profit, but still strategy is applicable. Yeah, I've built them myself, and also I'm the core contributor of Opium. We have automated strategies that do exactly the same, but on chain.
What is your strategy or logic behind setting the premium prices? You do that randomly or?
Yeah, you can do back testing and see what works more on which markets. So and basically use different profiles. Like for example, after the FTX crashed after November, the market is like not that attractive as it used to be. So the strike prices that we were using before are not that profitable. And here you can see that there is, from the current price, the strike prices are just ranging like, I don't know, 25% max. And you can't like basically with lower your risk lower than that with just still getting money. So depending on the back test and depending on the current market condition. So if it's growing market, then of course you are gonna have to set higher strike prices for the call options because otherwise you're gonna get liquidated and you don't want that. And if it's like market going down, that you can clearly set higher strike prices if you expect it to go down, or if you hedge this part, then you can clearly set higher strike prices for call options or smaller strike prices for put options.
So you always put it certain set percentage over or under the current.
Exactly. Yeah. So we call it like internally strike price delta, basically. So yeah, we just have the percentage. We get the current price of the asset. We apply delta on it, and we get the strike price.
I have a question. Can you maybe talk your opinion about the opportunities of DeFi and so on, and especially in the migration of Terra?
Yeah, so that's a good question. This is why I prepared this for you, so you can see the decentralized finance in general is its infancy. The options market or like derivatives markets, it's like even smaller, and it has much bigger growth. So for me, definitely it's a no-brainer to build derivatives as in general, like chain agnostic, regardless of where do you build it, because first of all, you gain like infrastructure around it, you gain knowledge around it, and in terms of tone, I think it definitely makes sense because as far as I know, there is nothing in there yet. So all you need to build this kind of stuff is oracles, basically. If you have those, or if you can like somehow mitigate those oracle risks, then you can start building that. And the automated trading strategies is a pretty good product that you can build because ordinary people can understand it. They can just go, like for them, it's just an investment opportunity. They just go and stake their money into the pool. They gain the APR. They forget about it. Pool is automatically working under the hood, so you can attract like more TVL into your product, more assets, and on another side, there is always market makers, arbitrageurs, bots that are willing to purchase these options from these pools, and the protocol can earn a lot of fees on that. So If you're looking into that, I would say that this is definitely a good start because it's just a new thing. It started to be popular like 1.5 years ago. We were actually pioneers there, and it still has a lot of potential. And if there is nothing like that on Tone, then you have to go and build it now.
Yes, it's very interesting. Like, we have a big opportunities to build a lot of stuff. We have already like the historical roadmap of Ethereum, the other ecosystem, how like all levels of DeFi. And it was started with wallets, some dexes, and then more and on financial instruments. It was kind of. Can you talk more about like some new stuff? I read a few days ago. It's like LSD, liquid staking derivatives. It's like how it's far from liquid staking in general, and what is it about?
Well, it's a completely different thing. First of all, liquid staking derivatives, they are called derivatives because it's a synthetic asset. So everything that's not a real asset and the synthetic contract, it's called a derivative. So that's the only like common thing with options, to be honest. And yeah, I'm not like that expert in liquid staking in general, so I cannot tell you like the pros and cons of different approaches. But what is good to know that these strategies you can be running with the liquid staking assets. So basically, instead of putting your Ethereum as a collateral here and earning like 10% APR in automated trading strategy, you can put your Ethereum into the staking, receive 5% APR, and then you use staked Ether as a collateral and receive 10% APR on top of that. So you're like compounding APRs. Of course, compounding risks, but staking risks consider it on the market as a low risk, more or less. So yeah, this is how you can combine those two things. Maybe if I don't know if I answered your question.
And like this is the most advanced thing now in DeFi, or there's like some new, I don't know, trends or concepts that is starting to develop like this year.
This year it's pretty low profile. Everyone is heads down building. I didn't see actually, to be honest, any like cool things in DeFi, except for a couple of automated market makers and leverage trading platforms. Um, yeah, but they are evolving. So the strategies involving selling or buying options are growing, and they're like this what I show you here is a simple strategy. So you but just sell one option or you call on one option put, but they are, for example, buying call, selling put, or selling call and selling put. So like you can short volatility, you can long volatility, you can do different combinations of those, and actually you can add futures on top of that and do some more financial engineering, which is the beauty of the whole thing.
Okay, yeah.
Can I ask a question? Uh, why why do we exclude U.S. citizens so much? Like I've heard it a lot of times in talking with you or this and everything, like that every KYC is mainly to exclude U.S. citizens. I just want to understand what is so wrong with them and how they are treated by the government. Like, of course, we exclude so the government wouldn't come and like fuck us, right?
Yeah.
But why? What exactly is the model? Is there like different DeFi inside of US that they're trying to defend, or what's the problem?
There is some DeFi inside of US, but it's not properly working. Recently, they even like disallowed to stake to actually have staking within the US.
Is it confirmed?
I don't know yet. Like it's 100% confirmed, but at least like
It's a big talk now.
the CEO of Coinbase, for example, he told about this, and I don't know if he can bullshit around for that stuff, but in general, like American government, they are protecting their citizens, so this is their main point, and they have like their protection written down in their law, and ordinary people um, who are not accredited investors, who are not like professional traders, um, they are getting scammed a lot of time. So this protection, like their main point is just to protect these kind of people who don't understand, who can get involved into some schemes they don't understand. So actually, it's less restrictive on the people who are officially accredited investors in US. They can participate, like they can invest, they can participate in this more complex DeFi stuff. So it's not for everyone. Yeah, and this is main point. But of course, it's not logical, it's not feasible, and of course, people actually cannot access stuff that are more profitable and more and better for them. Like in reality, how it ends up, they cannot access stuff that actually is good for them.
But if the person is like officially accredited in US, like officially accredited investor and everything, we still exclude him, right? Like in these KYCs, there is no, like we exclude US citizens, we don't exclude like uneducated, unaccredited US citizens.
It depends on the case. Like it depends on what you're doing. Actually, most of, like I would say probably even half of the deals, they don't exclude accredited investors. So it just depends on what you're doing. If it's like considered legal in the US, if it's legal in the US, if it's legal to sell to these people in the US, then you can go and get them. But it's very risky because US law works in a way that if you like in any way touch their ground, in any way you touch some of their people or whatever, they are not like happy with what you're offering them, then they can go and sue you. And if they can go and sue you, then it immediately becomes the jurisdiction of US, and then you have to comply with their law and so on and so on. So that's why everyone is just excluding, even some investment banks, like traditional finance website I can show you later, they have this non-US exclusion on their websites, like Web2 traditional finance websites. They do this as well.
Sorry, can I ask another question?
Yeah, sure.
Thank you very much for this one. It really kind of clicked now because I was like, we try to get rid of them, and but why? But the second question,
They did try to get rid of themselves. So
yeah. So the second question, I've been through at least 2 presentations of yours and a lot of talks in person, like about options and derivatives in general. Honestly speaking, I still don't have a plan how to do something like this. I barely understand the logic how I earn there, but it's kind of hard to put on my head. The question is, what uh, what materials or events or resources you could advise to actually maybe do some homework, to get a better understanding. Because when I don't know, I don't even know what I don't know. It's like basically it's hard to ask questions if you don't understand. Like, it's what would you advise to actually get a bit more familiar and then get hands on something like this?
well, theory. Read Investopedia. Like I got this question a lot, and to be honest, I answer Investopedia and Google to everyone because I haven't seen like any particular like good place where you can just go and learn everything about derivatives. There is a lot of materials. You can definitely look like what's the easiest part that you can also technically put it inside your head right away, and you can go and look what these protocols are doing that I described here. They have documentation, everything described. For example, at Opium, you can go to opium.watch, and there is like some theory on the strategies that are running there. And Investopedia, so you can get the like perspective of it in general. Also, you can go and trade these options yourself. Just for a small nominal, you can see how it works. You can see when are you losing, when are you gaining, and yeah, this is the beginning. So this is the core. And then you can look at the structured products. It's like a special topic in the banks, investment banks and everywhere. So structured products is basically the combination of these derivatives with something else, which is more like applicable to the real life. So like, I don't know, ordinary people, they don't use like pure options, but probably just insurance example that I told you. But you actually use options a lot every day, but you just don't know it. Banks do this for you. They structure it. They put it like into the complex products. They combine a lot of stuff together and they sell it to you. So yeah, so you can look at that. So the more you have like these real world examples, or you can apply this knowledge on the real world things, which you can learn about what banking do and so on, the more you will understand.
And if like it's obvious that you gotta have a lot of motivation to do this stuff like on your own and read and try and throw a couple $1,000 just to try how it works. But is there any like let's say, derivative hackathons. I mean, because at hackathons, you can first you smart people who already made it, then you can meet people like your level, and then you can meet people who are like a bit like less level. So they ask you questions, you start explaining something, and then you understand it better, you know? So like, is there any kind of like hackathons where like community like this could talk, you know?
Very good question. I'm wondering myself. Because I was thinking like, why don't we do a hackathon for Opium, for example, right? But it's not that easy. Like, it's not Uniswap where anyone can just go and plug in, like, you swap one token to another one. It's really complex. So people who go there, they cannot get this knowledge like within 2 days. It has to be like preparation, curation, and so on and so on. Yeah, but this is a good question. I haven't seen derivative hackathons yet, but I would love to see.
Yeah, let's do it.
I think it's a lot of work, to be honest.
With the Florida theory, I think GPT could also help with resources because you can actually ask questions.
That's true. That's true. Yeah, I think GPT. Yeah. Didn't.
That's the way I use it now for work.
Come on.
Yeah, definitely. Yeah, I'm learning like some of the C++ and Unreal Engine stuff now with GPT. Works good.
Yeah.
I have a question regarding your thoughts about the merging of the DeFi and financial instruments with the game world, with the metaverses, play to earn and play and earn games. What do you think about that? This is good or this is bad, and how it will evolve during the next years?
My personal opinions only. I think it's good, to be honest. But it also depends on the application itself. So, like, I see the concerns of some people that like life is getting more transactional if you put like GameFi or DeFi or whatever into your life. So it is getting transactional, but it works. And so for some people it's good, for some it's not. So I think like still people are gonna do what they like, and they're gonna be games that are like transactional and games that are not transactional, having assets on chain, like regardless whether there is a GameFi or not. I think it's smart decision because it's transparent, it's like easily manipulatable, and out you can do an automations in there and so on. So I think definitely like everyone should go and put everything on the blockchains where they will allow it, because it's just a next technological revolution step. And but I don't know. It's like if it's good or bad. I mean, everyone can choose for themselves what they like. I think it's good.
Okay. And the next question also related with the games. So there's a common opinion that in classic game industry, that is play to earn metaverses, all the blockchain integration with the games. It's a source of scamming and criminals and stealing the people money. But on the other hand, the same people sell for their fans, for their game players, for their games, the assets that is not tradable, and people can sell the game itself or the game assets in classic pattern or like in any classic game industry. And but in the crypto industry, if you buy the assets and you can sell it, this means that this is a scammy project or scam project. So what do you think about like this in general? Who is the scam people the most? The new blockchain games that provide an opportunity to trade and monetize players' game time spending in the game, or the classic game companies that sell the crystals to motivate people to spend money in the game for the addictive gaming mechanics?
Well, I think no one is coming. No one. Like there are of course scam projects which are like obvious scams. They are scammers. The rest are just doing their business. If there is like a demand, there is a supply. So if you sell it centralized or decentralized, if people are buying it, it's okay. In my opinion, and I think like we will just come up with more curation, probably similar system to the as US does for their investors. Like there will be like I don't know, curated list of games where you can enter and you are not going to be scammed immediately. Then only when you click like I'm an advanced gamer, go and scan me now. So I think that's going to be good if it's going to be like this. Yeah, probably some competitors to Steam will go and make good curated platform where everyone can list permissionless, but still no one can get robbed. I think it's in the future, couple of years, but yeah.
Thank you very much. Also, another question. It's also related to the previous one. It's about like how not to be scammed and choose the right project to invest in or contribute as a developer. So as we know, there are a few green flags when you do your own research. So it's like the public team that has no that does not hide the faces. The second and has the previous related experience in terms of software development or delivering the project. The other part is the security audits. So we all need every time need to check if if this contracts or the backend of the project is audited by the famous or accepted auditors. And what do you think about the first possible thing that this will be the next green flag? So in my opinion, is a DeFi insurance and basically insuring of your protocol as a developer. And what do you think about that trend? Is it coming or it will not so common in the next years? And if no, what is the other green flags regarding the previous line, like security audit and the public team?
Okay. About green flags, I have to think. About the insurance, it's there already, but it's also in the infancy since the insurance is also a derivatives. They are still experimenting with everything. So there are projects like Nexus Mutual, which are like have high TVL. They're on the market for a long time, but still some people are complaining that they're not like as effective as or efficient as they could be. And there are other, but they are like for professionals. So you need to go and find yourself an insurance and go and insure yourself and like keep track on all this stuff. Or there are other projects. Solus, I think it's called. So you just go log in with your wallet. It just checks all your positions that you hold, and it offers you immediately the insurance for all of them. And this insurance is perpetual. So basically, you're just allowing them to spend, I don't know, some of your tokens, and like every time, like on a block basis, probably you pay the premiums. And I think this is like a really good example for ordinary people. They don't have to like go and find or whatever. If they trust this insurance company, as we do right in our real world, then they just go like opt in to this perpetual automated insuring of everything they hold, and they're good to.
What do you think? How will DeFi insurance evolve? Like in the automated way, where, for example, we deposit or we insure our deposits in lending protocols, for example. So in that way, we can make the execution of the insurance like automatically, or it will be mostly involved in the DAO forums where the people on the forum will explain their cases by cases, and the community of the insurance DAO will vote to cover the case or decline.
Well, I'm a big DAO believer, and but regarding the insurance, I think there are cool Oracle systems which allow to do this. For example, what UMA did and the Opium did as well is called optimistic oracles, where, for example, the outcome you push it right away on chain, but it has a time restriction where people can go and challenge it and say, no, it's wrong. I put my money on that, and so on. So this is one approach. And the similar approach, but more widely curated and could be actually combined with all of this, is what clearers are doing. They have like juries, basically. So people who are deciding, like a jury in the government, they're deciding on the outcomes based on some economical incentives. I think this might work. Like what good approach UMA did in their first version. I don't know if they still it still remains in the second version. They have a calculation of cost of corruption and profit from corruption. So basically, they have to like keep the balance of everything they're securing with their decisions, with their oracles. They have to keep the balance that cost of corruption is always bigger than the profit from corruption. So this economic constraint drives their optimistic oracles, for example.
Thank you. Thank you very much.
If I may, I have one more question, actually regarding the trading modes. Would you recommend some specific app platform to take care of this trading modes to set up? I know 3 commas.
I recommend that. 3 commas is good. I don't know, like Binance, they used to have very bad options, American options, and I didn't like them. They were very costly and shitty. I think right now they have European options which are good, but I did not check them out. And Binance has like pretty good internal automation, but 3 comma I would definitely recommend, because they have a lot of integrations. Then they support options, and they support Deribit, they support Binance, so you can trade even arbitrage between those two. So. But I don't know if they support like DeFi, or at least fully support DeFi. For DeFi stuff, to do this kind of arbitrage, you are going to have to write probably your own solutions, because there is not much of the open source bots for derivatives. We tried once to make one from the Hummingbot, which is created for spot trading, but it was a disaster. So.
How big is Opium?
It's volatile as Ethereum. Right now, I think we have like probably 7 team members, like who are the core team, and everyone who are the core team, and we have like part-time contributors as well, and we have like external, completely anonymous contributors from the internet as well. So.
Can you please tell us more how the Opium was beginning, and the story of the project, and maybe to how you received the first funding, and how it was like at the first stages, so where you find the resources to develop, where this idea came up, and what was your previous experience that was preparing you for that moment to start Opium?
Yeah. So me personally, I did not. As I said before, I was not involved like in finance at all before starting working on Opium, and I had to learn a lot. So my first months in Opium was basically, or maybe even 2 months, was basically just reading, and I had to learn a lot from the co-founder Andrei. He used to be a hedge fund manager, and he used to have like a lot of assets under the management, and he taught all this stuff. So basically we combined like technical and financial logic, and we started working on that. And to be honest, our vision regarding the product was changing all the time. So like what we have right now, like Opium Finance platform, for example, is a third iteration of what we were doing, and right now we are actually moving like from it completely to different things. So I think it's hard to tell like when you can stop. We still see fit like for all of stuff that we were doing, but probably some of them more or better for the current circumstances. And I think we started to like think about raising funds. We raised fund October 2020. Big players. And Rockaway, you know them, pretty good investment. Yeah,
derivatives. And this is why, like, I'm so much in love with the project Opium, and because Andre was explaining like derivatives in general on this podcast. I listened to this podcast a few times before this whole thing, and I just really advise you to go and look at the podcast name. It will tell you a lot about how because I personally I feel like a guy from when the DeFi is built by like guys who just know program, and then they invent a new event. This is bullshit. But when a person like a hedge fund leader is coming like, you think, okay, did he fail in hedge funding, and that's why he came to crypto? No, like in this podcast, you can actually follow his like thought path. That I was impressed that I was just realized it just made more sense to go and do the blockchain. And like as far as I know, Opium is mostly B2B. And for me, it was like a shock that you guys sold blockchain to banks, like and not like to the business players who are kind of like those players now using blockchain. Players now use all certain like derivatives stuff. And this is just I think it's a big precedent that is good.
Yeah. But also, not like I wouldn't agree on the side on the first thing you said. I think like programmers can come up with a new concept, but it's not. It shouldn't be like the whole thing. Like for example, only blockchain allowed us to have a new financial primitives. For example, flash loans. So flash loan is like impossible, completely impossible in the real world finance. And this is a new thing which was brought by developers. So yeah.
Thank you very much.
Thank you.